Hello, 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 and welcome back to today's podcast. Thank you very much for being here. I appreciate it. Hey, today we are going to talk about all things life insurance. And I have talked about this before, and it seems like I talk about it a lot, but apparently there are people out there really doing a fantastic job marketing the indexed universal life. They're talking about, just regular universal life, variable universal life. And so let's spend a little time breaking down what these universal life policies are compared to whole life. Now, this is something that I have talked about before, but apparently I need to talk about it again because I have had 2 questions on it in the last week. And I just got back from a trip to Arizona where we spent a lot of time just breaking down different kinds of policies with the life insurance companies. And we ended up talking about this subject as well. So that means 3 times in a week. And that is a sign that says, Mary Jo, please explain more. So here we go. If you buy whole life, this is the age-old, probably the biggest objection, right? Is it's too expensive, Mary Jo. Okay, but does anybody ever ask why it's expensive? Instead, most people assume that life insurance agents who sell whole life are making a whole bunch of commission, and because they paid more for that insurance, all that extra money went to pay people like myself commission. That is not where all this money is going. The reason that whole life is more expensive is because it is guaranteed to go your whole life. Meaning, if you live until 121, the life insurance company said, all right, you are 35 years old, you are 50 years old, we're going to expect you to live until 121. This is what your cost of insurance is to live to 121. That means that every insurance policy has what is called a cost of insurance, okay? That cost of insurance is what the insurance company needs to charge so that they have enough money to pay the claim. Most insurance companies, it is going to take them 10 to 15 years of premium to be able to pay a claim. So if you die soon, guess what? They didn't make any money. It was hurtful for the company if we die before 15 years. So when you buy insurance, you have to go through underwriting. The life insurance company wants to make sure that you are healthy so that they have that policy on their books for at least 15 years. Okay? That insurance is guaranteed by contract. All right. There is nothing about a rate of return on the market in those policies. The insurance company is not basing your guarantee on some hypothetical rate of return. This is what you pay. This is what you get over your lifetime. It is frankly that simple. The whole life policy is bundled, as the life insurance company explained it last week, which was a great explanation. It is a bundle. All of the cost of insurance is already built in to that life insurance policy. The rates aren't going to go up. That's already figured there. Okay? Do you have to go through underwriting? Do you have to be healthy? Absolutely, because they're taking that risk until the day you die. If you outlive the policy, they're going to pay that out to you. All right. Now, let's talk about universal life, variable life, and indexed. First came along universal life. Universal life has a guarantee. Typically, they will have a guarantee. That's what I've never seen one without an actual guarantee. Rate of return. Okay. Remember, I said whole life is not figured on some rate of return in the market. Universal life, they take that money and they go to the market and say, we're going to use your premium dollars and we're going to invest it and we're going to get X amount of rate of return. But we will guarantee a certain amount. Most universal life policies that are old, we're going to guarantee 4%, 3%, 3.25%, something like that is normally what I see. Here's the difference. Whole life has a guarantee, universal has a guarantee. What is not guaranteed in universal life are the expenses. And on top of cost of insurance expenses, because there's a cost for every dollar of death benefit, right? That's in whole life, that's in universal, that's in variable, that's in indexed. There's a cost, but on top of those expenses for cost of insurance, there are fees because we've managed this portfolio. So now all of this is not figured into this nice little bundle. That 4% is going to be a gross rate. That's not going to be net. Then we're going to take all these expenses and fees out. And then are we at 4%? No. We can also, in those policies, in a universal life, the insurance company can also raise the cost of insurance, which means, you know what? That 4% isn't working so good. We can't go get investments making 4%. They're going to maybe make 2 or 3 with today's rates. So we're just going to bump up that cost of insurance. What happens when we bump up the cost of insurance? It comes out of our pocket as the policy holder. Okay? There's no guaranteed contract that says that they can't raise cost of insurance. So now the premium we were paying is not sufficient because we're not making enough return in the market. So in a universal and a variable and an indexed, guess what happens? We rate in a whole life, we say, you know what, your premium's going to be $5,000 a year. In a universal life, they're going to come in and say, oh, your premium is only going to be $2,500 a year. Because they're expecting the rate of return to make up the difference from what you're paying out of pocket. When it doesn't do that, they start taking from cash value to make up the difference. Eventually, cash value is going to hit 0. And when it does, they send you a nice little letter that says, oh, guess what? We now have to increase your premium to keep the death benefit going. I talked to a lady a couple weeks ago that this exact thing happened. They were going to have to pay in another $500,000 over the next, she's like 72. So to get them to maybe 85 or 95, I don't even know how long it was. Let's just say 95. They were going to have to pay in another $500,000 to keep that death benefit. Otherwise, the policy lapses and it's gone. And the agent said, oh, this is how these work. That is complete BS. If the premium is set correctly, they can be decent policies, okay? But the premium is never set correctly because us as a consumer goes to the insurance agent and acts like we're buying insurance from Walmart and we don't want to overpay, right? Because we've been taught that life insurance is the worst thing ever. So with the universal life, there's a guarantee on the rate of return, but there is not a guarantee on the cost of insurance expense, on the fees inside these policies. If you've read my book, I have an example in my book of the fees and the charges, okay? And why that's coming out. All the risk is on you. Now that's a universal life. A variable universal life. So universal came out and they're kind of the chassis, and then underneath, then we've built onto them trying to make them better, and we've just made them worse. So variable, now there's no guarantees. It's all subject to market returns. no guarantees, and we can go negative. Okay? So we can have, there's no guarantees on rate of return, there's no guarantees of cost of insurance, and then we have our fees and everything else that come out of our pocket at the end of the day. Then we have an indexed universal life, which is what we're hearing about like in the droves right now, because all of these people that are out there talking about indexed UL are doing it for two reasons. Well, basically one reason: rate of return. They are telling you that you can buy this life insurance policy and you are going to get this phenomenal rate of return. And guess what? You're never going to go below zero. If the market crashes, you're never going to go below zero like you would in a variable policy. So, but you have an option to make a better rate of return because the money's not directly in the market, it's reflective of the index. Oh, it's fantastic. This is just the best thing since sliced bread. Okay, my friends, this is not any better than a variable policy, in my opinion. Why? Because I have seen the illustrations. When the policy is supposed to do a 0% rate of return, guess what it's doing? A negative after fees and cost of insurance expenses. Well, I thought it was never supposed to go negative. It's not supposed to be a negative gross rate. It is a negative net rate. Okay? So now we actually did go negative. And again, we are hoping that the indexed makes this great rate of return. So you again take all the risk. Again, that rate of return is supposed to make up the difference for what the cost is, the true cost of insurance. They can raise the cost of insurance on all of these policies. Most of them do. There are tons of lawsuits out there. Well, I shouldn't say tons. Okay. It's a bit of an exaggeration. There are several companies over the years that have been sued for raising their cost of insurance because the consumer in the end has to pay more or loses the policy because they can't afford to pay more. All of this makes whole life insurance look really, really bad because whole life insurance is expensive. No. Whole life insurance is priced accordingly so that claim can be paid. That is all. It is that simple. Whole life insurance has the guarantees. Here's another example. I had a client years ago come to me with their universal life policy. And I said, this thing is going to collapse. It's part of your estate plan, but it's going to collapse before you are likely to pass because it collapsed about 80, I believe. And I said, it's going to collapse before you are likely to pass. I would suggest that you get something that's going to be guaranteed your whole life. Okay? Then on the illustration, they got what's called an in-force illustration. You can order an in-force illustration and it will show you all the columns and when those columns start to hit zero based on certain rates of return. On that illustration, it showed when it's going to hit zero. On the side, on the right side of the illustration, it said, if you want this policy to go to age 100, this is the premium you should be paying. When I ran a whole life illustration based on the same age that they issued their policy at for the same amount of death benefit, guess what the premium was? The same amount the universal life was suggesting that they pay to keep it going to age 100. Pretty ironic, huh? So when you're telling me that whole life is more expensive, that is a false statement. Now, I actually ran this by the life insurance company because I've been in the business for 12 years. I'm fairly ancient in this business at this point, but the gentleman at the life insurance company has been in this business for 30 years. So I said, is that an accurate statement? And he said, yes. When we run them, the price has to be the same. It doesn't matter. You have companies that sell whole life, universal life, variable, and indexed. Some companies will sell them all, the same company. Do you think the cost of insurance, the actuaries sit in the back room and go, okay, this is whole life. We're going to charge more per dollar of death benefit to keep this going than universal life? No, it's the same person. They're going to need to have the same amount of money to cover that claim for that same person. The risk isn't any different if it's a different policy. We just shift the risk. With whole life, the risk is on the insurance company. With universal life and variable and index, the risk is on the insured. How many insureds are going to come back and run in-force illustrations every single year to make sure that that policy is performing exactly like it should? None. None. Because most of you listening don't even know what an in-force illustration is. The agent's not sat down with you and explained it. Because when I sit down with people who have universal, indexed, and variable life, and I explain to them what the columns mean and the risk that there is there, they get angry because nobody explained that to them. Yet, as an agent, if you're selling that product, you need to explain that risk. But nope, nobody's explained it. Not every single company raises their cost of insurance. But that doesn't matter. Most agents, even if, let's just say that the insurance company does not raise their cost of insurance, most agents will sell that policy based on premium that should be very small versus the correct premium. So it's called underfunding. We are underfunding that policy and not paying enough premium. We want a Cadillac on a Chevy Malibu budget, right? We can't have that. You don't get to drive the nice car and pay less for it. So we have to understand what we're buying. And we are not, here's my other thing, and I talk about this all the time. We are not chasing a rate of return. For the love of Pete, we are looking for liquidity, control, and guarantees. If you understand infinite banking, that's what you're doing. If you want to chase a rate of return, please go buy a mutual fund or, invest in a mutual fund, put money in your 401k, go get an IRA, do those things. Do not tie your death benefit that is meant for estate planning and for your family. Do not tie that up into a rate of return to where when we get too old, we don't even have it. Now, the lovely lady that I talked to a couple weeks ago, we just gave up $2 million of death benefit because we could not afford the extra premium. That was for estate planning. Now what? Now we have to refigure the estate plan. Now we might have somebody buying somebody else out. $2 million is a lot of money. If we're doing this for a purpose, stop chasing a rate of return. If you have a policy with me and somebody comes up to you and says, oh my God, Mary Jo is so stupid, I could get a better rate of return. Your answer should be, it's not about the rate of return. It is about liquidity. Because here is the other thing. When you borrow against a universal life policy, any one of those, it does not act like if you borrow against a whole life policy. Okay? It is not the same. is not the same. If you're chasing a rate of return, stop. Just stop. Like this lovely lady I follow on TikTok. I love her. She's like, just stop it, people. We are not going to change the way farming is financed if we do not have some guarantees to do so. You are not going to have a guaranteed estate plan if you buy universal-based policies. If it's built on a universal chassis, it is not whole life. It is not guaranteed. And then, okay, well, let me add one more thing here, and then I may be done. There is also a guaranteed death benefit. So some of you may have a universal-based chassis policy, universal variable index, okay? You may have one of those policies, but you say, well, Mary Jo, when the death or when the cash value hits zero, the death benefit keeps going. All I have to do is pay premium. Great. There is a caveat to that. If you're ever late on your premium, if you've taken a policy loan, if anything has ever just been a little bit goofy, that death benefit does not have to get paid depending on what that policy contract says. So if you have what I would call a guaranteed death benefit, and sometimes it's a rider type thing, you are going to want to read the contract language on that, okay? This is super, super important because when you die, they don't have to pay that claim because you maybe didn't pay premium exactly on time. Your premium, there's a 30-day, typically when you have a life insurance policy, there is a 30-day grace period and you have within the 30 days to pay it. If you ever use that 30-day period, they don't have to pay it. But they are happy to keep taking your premium. Clearly, I don't like these, but even worse, it is super, super frustrating to me that we are not paying attention and educating ourselves on why whole life versus universal versus variable versus indexed. All these people are out there screaming from the rooftops, rates of return. And it's not about a rate of return. It's about a guarantee. It's about liquidity of money. It's about uninterrupted compound interest. Please remember that. And these agents are just going to say, I can give you a bigger rate of return with less premium. Nothing is free in the life insurance world. The cost of insurance and the cost to do business is the same, regardless of what you're buying. If something is cheaper, it's cheaper for a reason. And you better figure out what that reason is. And I can tell you, it's because you're taking all the risk. You are being oversold on something that is not guaranteed. Pay attention to what you're being sold. Pay attention to what you have. Pay attention to what mom and dad have. If you are farming and ranching, if you have a business and that's part of the estate plan, pay attention. This is huge, 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 because this is what I don't like. I don't like to see somebody at 60 and 65 years old and they say, well, Mary Jo, my policy is going to end in 10 years and I'm not insurable. Or I don't like to see people that say, oh yeah, mom and dad have a policy and they're 75 years old and the in-force illustration shows that it's going to collapse in the next 2 to 3 years. Or better yet, you get a statement and on the statement, it will tell you if premiums are continually paid as is, this policy will lapse in your yada, yada, yada. Yeah, it says it on the statement. Please pay attention. Please share this with people. Just as we can talk about everything else with our friends, why are we not talking about financials and life insurance? Okay. The only people that don't want to talk about it are people that have a ton of debt and they don't want to move forward in life. Wealthy people talk about their money amongst each other all the time. All the time. As I'm recording this, everybody knows how much money Elon Musk has. Everybody knows how much money Bill Gates has, right? Wealthy people don't mind sharing what they're doing to create wealth. Instead, they share that information. I think I said that wrong. Wealthy people do not mind sharing how they created their wealth. Okay? We think that that is horrible to talk about money. We've even got past the point of not talking about politics. Everybody talks about politics. There's not a problem with it if we understand it. This needs to be discussed. When we have life insurance companies being sued because they are over projecting on when they sell a policy and there's no guarantees, you, the consumer, need to understand what you're buying. If you have more questions on that, please email me. Mary Jo at Without the Bank. Leave a comment if you're watching on YouTube, whatever. If you've not gotten the books, any one of my books, Farming Without the Bank, Life Without the Bank, if you've not gotten Nelson's book, Becoming Your Own Banker, please go to my websites and do that. You can either go to Farming Without the Bank or Without the Bank, either one, I don't care. Please stop there, grab the books, educate yourself on what we are doing here. Because my friends, it is not about a rate of return. You guys, that's it. That's all I've got today. And you have a fantastic rest of your day.